Welcome to the Daily Drawdown, where AI's enormous build-out meets markets, power, policy, and politics. Nvidia just showed how much AI demand is still waiting to be served. The bigger question is whether power, financing, communities, and policy can keep up with it. Nvidia guided for roughly 70% revenue growth in its next fiscal year, far above the 44% to 45% consensus range. Management said unconstrained supply could support 75% to 100% growth, with industry demand reportedly running about 12 times available supply. The report added roughly $360 billion to $400 billion of market value and pushed Nvidia toward a $5.5 trillion valuation. One company is still capable of moving the whole market. Its edge runs through CUDA, rack-scale systems, software, supply access, and a customer base that must upgrade heavily used equipment every 3 or 4 years. Vera Rubin is ramping on schedule, and Nvidia sees a far larger revenue opportunity per gigawatt as inference expands. Watch the constraint list: memory, wafers, racks, land, and especially power. Nvidia's direct supplier agreements reportedly approach $300 billion, helping it secure scarce inputs while competitors struggle to match the supply chain. The AI build-out is becoming a global investment supercycle. Roughly $1.3 trillion of AI-related capital expenditure is expected next year, alongside about $500 billion of global issuance this year. That scale reaches far beyond chips. It means transformers, networking, piping, specialized freight, construction, and generation. It also shifts the next phase toward inference: physical AI, robotics, memory bandwidth, power efficiency, and custom silicon. Margins show the strain. Higher memory costs took Nvidia's gross margin from 75% to 74% below expectations. The company expects price increases of roughly 15% to 17% and forecast margins recovering towards 72% to 73%. The financing deserves equal attention. About 20% of data center capex may be debt financed, and investors are looking closely at vendor financing, receivables, guarantees, supply commitments, and cancellation penalties. Businesses already monetizing demand stand on firmer ground than infrastructure valuations requiring years of uninterrupted spending. Data center opposition has surfaced in 23 states, and 71% of Wall Street Journal survey respondents said they would oppose a local facility. Political support for pauses or restrictions is appearing in Pennsylvania, Texas, Michigan, and other states. That resistance can delay projects, redirect them, and create election risk around spending plans that assume 5 more years of rapid construction. Global project backlogs remain enormous, so the build-out continues potentially on a slower and more extended timetable. Energy is raising the stakes. Diesel has reached $5.62 a gallon, inventories are nearing levels last seen in 2003, and disrupted Middle Eastern distillate flows plus attacks on Russian refining infrastructure are tightening supply. Higher freight surcharges can work their way into consumer prices. Crude near $100 and rising long-term yields would challenge equities at the same time. The Army's selection of 5 companies to develop transportable microreactors points toward one response: resilient, on-site power for bases, data centers, hospitals, factories, and municipalities. The software rebound gained real evidence. Salesforce rallied roughly 20% to 22.5% after raising its outlook, reporting strong net new orders, near record low attrition, 81% free cash flow growth, and 240% growth in Agentforce annual recurring revenue. Its AI assistant resolved 45% of support cases without human intervention, while support cost per booking fell 16%. The test for software now is earnings revisions and durable customer expansion as AI changes how buyers consume modules and features. Cybersecurity carries a clearer urgency. CrowdStrike and Okta rose sharply after beats and higher guidance, reflecting demand for security, privacy, identity, compliance, and data protection as companies deploy AI agents. Attackers are using AI too, including for zero-day discovery and persistent agent swarms. Okta is securing agent identities and permissions, while CrowdStrike is pushing continuous and coordinated defense. Valuations are rich, yet the security requirement is fundamental to enterprise AI adoption. AI pricing is moving from experimentation toward budget control. A cited McKinsey survey found 93% of enterprises had exceeded their AI budgets. Google is pressing a value strategy with pay-as-you-go agents, token discounts, hard spending caps, and a $0 subscription option. Anthropic held 44% of U.S. business adoption in ramp data. OpenAI had 40%, and Google remained below 10%. Expect a more complicated mix of seat fees, usage charges, and overage surcharges. That makes 2027 enterprise AI budgets harder to forecast and raises the importance of measurable returns. Jackson Hole could leave markets with more questions than answers. A CNBC survey found 45% expect Kevin Warsh to offer no meaningful policy information, while 32% expect a hawkish message. The Fed remains divided between inflation that has stayed above target for more than 5 years, sticky services prices, and conditions that appear easy, versus weak growth, slowing wages, and limited job creation. PCE inflation was cited at 3.3%, with the latest monthly reading annualizing near 3%. Holding rates steady remains the base case until the data clarify the path. Inflation expectations, tariffs, energy disruption, or an Iran-related shock could change that calculation. A less predictable Fed means wider uncertainty bands for bonds and risk assets. The S&P 500 also remains highly exposed to a few AI leaders, even as roughly 75% of stocks were above their 50-day moving averages and healthcare and financials supported the market during tech's correction. With high real treasury yields available, diversification across bonds, global equities, and non-AI sectors matters. Retail results show a split consumer. Dollar General, Dollar Tree, and Gap delivered improving comparable sales, while company-specific guidance and execution still drove sharply different stock reactions. Travel remains resilient. Labor Day bookings rose 17% year-over-year despite hotel rates above $500 and airfares above $1,000. Consumers are reallocating, taking shorter or more frequent trips, and using price tools and points. Fast food is feeling the affordability pressure as well. McDonald's has fallen from an earlier all-time high to its lowest level since July 2024, challenging the assumption that value restaurants automatically gain from a squeezed consumer. Nike's turnaround remains a 2027 story. The company retains roughly 20% of the global sneaker market and trades near one-time sales, with a roughly 4.2% dividend yield, while the recovery depends on renewed performance footwear growth, product innovation, and better distribution. Revolution Medicines received FDA approval for RAS-on-Q in eligible metastatic pancreatic cancer patients. Trial data showed median survival of 13.2 months versus 6.7 months with chemotherapy, alongside a 60% reduction in death risk. Access is now central. Treatment costs nearly $40,000 every 30 days. The drug is not a cure, and follow-on research in resistance, lung cancer, and colorectal cancer remains crucial. Meta also agreed to pay up to $17 billion in a multi-state youth harm case, including $11.66 billion guaranteed. The settlement includes teen time limits, overnight blocks, parental controls, independent auditing, and court oversight, while related cases continue against TikTok, Snap, and YouTube. That's the Daily Drawdown. Watch power, debt, yields, and political resistance, because they'll determine how much of the AI demand wave turns into deployed capacity. This episode was generated by Podkey. Create your own at podkey.fm.